Welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank by applying the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sarry Ibrahim. Today, Mark Willis of Lake Growth Financial Services and I talk about what is happening in the banking world, specifically why banks are in danger as we record this episode in mid 2023. We'll also discuss what depositors and customers need to know to protect themselves in these uncertain times. Hey, Mark, welcome back to our podcast.
Sarry, glad to be on, man. Thanks for having me.
Yeah, thank you for joining us. So before we were recording, we were talking about what's going on with like banks. If you haven't been watching the news or listening to the news, a lot of things are happening with banks right now. It's a really shaky time. Why is that? Like, what can you break that down? Like, what is the problem or some of the problems happening in the banking industry now?
Yeah, I can't say that we're in normal times. We're in very weird times. And the unfortunate truth is, this is not the first or even really the biggest financial calamity that we've seen in our lifetimes with banks as we're recording this. Now, it could mushroom to become even greater than 2008's banking crisis. But even though we're not hearing it much called a banking crisis, that's exactly what it is. We're seeing many mid-sized regional banks hit financial turbulence, and it's for a lot of the same reasons that they hit turbulence in 2008. They were taking unsafe bets with people's deposits because they can do something with your money when you deposit it with the bank. I think a lot of people believe that when you deposit money into a bank, that it's just in some shoebox with your name on it in some vault somewhere. And that's just nothing further from the truth. Now, people think that, but candidly, Sarry, when you push people to say, well, where does the money go when you lend it, or when you give it, I should say, when you give it to the bank, when people are really faced with that question, they have to admit, yes, they probably loan it out to somebody else. And that has a register in people's minds, but honestly, when they really stop to ponder what that means, it quickly becomes apparent to them, and to, I think, your listeners, that there is no money at the bank. And when there's no money at the bank, it's not that different from the movie It's a Wonderful Life. Remember this movie? It's a Wonderful Life, where, what's his name, George Bailey or whatever, he owns a little family bank, and then there's a run on the bank for various reasons, and he's freaking out because he has no money. He's like, "Hey, I don't have your money, Sammy. It's in Susie's, car payment. It's in Johnny's mortgage payment. It's in everybody else's pockets due to fractional reserve banking." So that's been the law of the land for many years, but it's become a lot worse in recent years, and we're seeing more and more as interest rates rise and the portfolio of valued debt falls. That has caused a lot of banks to become under the pressure of insolvency, and that's what we're seeing in the news. Many banks are now calling it quits, bankruptcy, and being sold for parts.
I see that, right? And I think throughout history and throughout, especially right now, I've heard a lot of people like interchangeably use banks and insurance companies as if they're the same thing. Like, oh yeah, banks and insurance companies borrow money, banks and insurance companies loan money out. But really, it's not the same thing, right? Do you mind describing the differences, like when an insurance company loans out money or stores money versus how a bank does that?
Yeah, I mean, and since this is your show, I'll let you take some lead on this as well. But you're right. Banks are allowed to do something where they create money out of nothing. When I give money, let's say $10,000 into my savings account, when I deposit that money, banks are allowed to, create money out of nothing by loaning out 100,000, because they know that I might not require all 10,000 of my monies all at once. And even if I do, 10 other people, 9 other people can, keep the bank solvent by not requesting all of their money at the same time that I request mine as a withdrawal. Now, life insurance companies are not allowed to inflate the money supply like that. They have to keep all of my deposit and then more on their balance sheet, because why?
They're
Why do you
required
think?
to. They
Yeah,
have
they're
to.
required to.
Yeah.
Yeah. And why are they required to? Well, because there's a liability called a death benefit. So most people are like, well, Mark, why are you so into life insurance? Why not just use some other cool, more sexy financial product? And the honest truth is because only life insurance has a guaranteed asset for my family that is a liability to somebody else, the insurance company. So they have to have ready to go more than all of my cash value in case I croak this afternoon to pay my family, 10 times my cash value or whatever that math works out to for each person's policy. So bottom line is insurance companies are not allowed to do fractional reserve banking the same way that banks are allowed to do. So what would you add to that?
Yeah, and then also to the way we structure the life policies, they go up in value. The cash value and the life insurance both go up in value, which means that not only are life insurance companies required to meet the death benefit, like today if you pass away, but also 30 or 40 or 60 or 80 years from now, when the value is probably double or triple. So that means that insurance companies have to do certain things to grow their reserves. They can't just park it in a zero interest account. They have to do certain things. And then typically what they're doing, right, is they're investing in mostly interest earning activities. So guaranteed contracts. So they're guaranteeing treasury bills, bonds, money market mutual funds, high interest savings accounts. They're doing certain things that are going to inflate they're going to grow their accounts so that they can meet the demands of the customers, which is kind of different from what banks do because banks are just hoping that their depositors keep the money there and they're hoping they can get the leverage and they're hoping that both sides work out.
You bet. Yeah. So you've brought up bonds and money market mutual funds and some other high interest savings and so forth. They must keep that money fairly liquid in case too many people pass away tomorrow. They have to pay out a death benefit within a couple of weeks, really. My mom passed away a few years ago, and I received the death benefit from these life insurance companies within about 2 weeks. It was about 7 to 10 days or so, and we got the checks. So to have that kind of giant liquidity fund is a pretty phenomenal feat that banks just don't have. It's amazing how razor thin their margins are in terms of liquid margin, because we're now seeing, as Warren Buffett likes to say, when the tide goes out, you see who's swimming naked.
Yep.
And the liquidity of banks is showing they're going to go under faster, whereas life insurance companies are holding strong. There was a study we did for an episode, and in 2008, over 400 banks. We're talking at this time of this recording, what are we up to now? 4 or 5 banks have gone bankrupt. We're at like PacWest was the most recent one. We're recording this in early May. So there might have been more when this goes live, but 4 or 5 banks, and it's making headlines. Well, in 2008, it was over 400 banks went bankrupt. Not a single mutually owned life insurance company went bankrupt in 2008. And that says something about the strength, right?
It was only, I think, AIG's investment division, right? Not their insurance company, their investment division or their, I guess, broker dealer division. That's what, their volatile section or department.
That's right. So 2 things. One, AIG, their investment division, their mortgage division what went bankrupt. 2, the National Association of Insurance Commissioners did a study on AIG, kind of a post-mortem, you might say.
Yeah.
And they found that the life insurance division was what helped save AIG because it's still in business today.
Yes,
so the life insurance business was the best part of the business overall. And then third, I would just mention they are not a mutually owned life insurance company. AIG is not mutually owned. And I am just of the opinion that when you are owned by the same people who have a lifelong stake in your success, you as a business are going to make smarter, I don't want to say smarter, but you're going to have a different horizon of time horizon when you're working on 75-year, lives. And when your owners are stockholders, you're going to be more interested in quarterly performance, aren't you?
Yeah. When you're a stock-owned company, I feel like you're just a tool for investors, for Wall Street, for other institutional investors to be used. Like you're just a company, a security in essence, to be used. So I guess, how bad of a problem is it? Like, let's just say what happened in Silicon Valley happens to like 100 more banks. Does it really impact us? Like, can we really feel that as customers?
I'd like to know your thoughts on this. I mean, really, given where we are right now in this economy, if we do Silicon Valley Bank a
Mhm.
hundred more times, what do you think is going to happen?
So I know that there is FDIC insurance up to a certain point, I believe $250,000 per account. So I
Mhm.
think that'll kick in. I don't know if there are any limits to the amount of FDIC insurance out there. So I think that's where it's at. But then what happens to people who have more than $250,000 in various accounts? And then it would probably scare a lot of other people, and then they would take money out of their bank accounts, and then it would scare a lot of investors, and they would sell their stock in other publicly traded banks,
Yep.
which probably means that if anything, it's going to be worse for publicly traded banks. I think then it could probably create some sort of room or benefit for credit unions, because I think credit unions are in essence like mutually owned banks. So
Mm.
that could probably save the day, but I don't know. What are your thoughts on that? Do you think there's any difference, or are credit unions also in the same trouble as banks are?
Well, there's a lot of small, very
Yeah.
large group of very small banks under 100 million. And then we've got these mid-sized regionals that have been showing up in the news mostly. And then you've got the mega banks that are, your JP Morgans and Bank of Americas and so forth.
Hmm.
I think FDIC is maybe one of the worst parts of our banking system, candidly. All right. And here's why I think that. So again, I'm a bold opinion. I could be way wrong. Call me a, crazy cuckoo guy, whatever. But why is what would happen if we did not have an FDIC? Well, one, we'd have higher interest rates on our savings accounts because every bank has to pay money to FDIC to fill in the coffers at FDIC. Okay, so if they're not paying money to FDIC, they can be more competitive with their savings rates and attract us as savers to go deposit money at their banks.
Hmm.
Okay, so FDIC sucks money out of, there's a large sucking sound coming from the FDIC, and it takes money out of your bank balance sheet and puts it on theirs. So when you have an insurance policy um, that on your bank, you're typically like, if I just went around without any um, home insurance, I probably would be a lot more careful with starting a fire in my fireplace. Like I'm still
Yeah.
pretty careful,
Yeah.
but if I didn't have homeowners insurance, I probably would like get rid of all matches in my entire house and make sure that I'm soaking it with water every day and everything like that.
Yeah.
The point is, when you have insurance, sometimes you take a bit more risk,
Yeah.
and that's what happens with banks. And honestly, I don't. Did you investigate your bank's balance sheet, Sarry, before you opened up your checking account with them, or
No,
did you
absolutely
just
not.
open up a checking account? Of course not,
I
right?
just follow the herd and open up a bank
Yeah, yeah,
account.
me too, me too. So I did not investigate my bank when I was opening up my bank account. I didn't check to see if they were sound. Well,
Mhm.
before FDIC, that was pretty well what we did. There could be, think about it. If we didn't have an FDIC, we could have a little consumer reports guide for which
Yeah.
banks are safer and which ones have better balances. We don't care about any of that. We just open up the nearest bank and we just get on with our life. Okay, so now let me answer your question.
Yeah.
I think there is no FDIC for credit unions, but there's a similar entity out
Yeah.
there for credit unions. I forget what it's called actually,
Yeah. I
but
remember it too. It's like a
yeah,
different association or division.
another acronym. Yeah.
Yeah. Yeah. Yeah.
Well, okay. So as of the end of 2022, there was a fund for banks that were in trouble at the FDIC. Basically, it's their reserves, what they had access to, what they had saved, and grand total at the end of 2022, it was 128 billion dollars to cover losses of depositors if a bank went bankrupt. All right, but after FDIC seized First Republic Bank
Yeah.
and after Silicon Valley Bank and its failures, that was a loss down to, now we're just down to 92 billion, which sounds like a lot. But if you think about all of the,
Yeah.
what is the total deposits of all bank accounts in this country?
I mean, you could just probably like you could probably come up with an estimate based off the GDP, like how big the economy is as a country, and then probably, I mean, trillions of
Mm,
dollars. It has to be trillions of dollars in cash and reserve and deposits. I mean,
yeah, yeah. As I'm looking at it here, am I reading right? It's a 17.1 trillion dollars of bank deposits. So 92 billion is what we're down to at the FDIC. If we have just a couple more bank failures, and they keep giving us clearance to cover all the deposits above 250,000. I mean, when are we going to be out of money at FDIC? Not too many
Right.
more big banks are going to have to go down before we're out of FDIC coverage.
And then at that point, like if banks went under and then the depositors lost money and then FDIC insurance ran out of their reserves, then plain and simple, the customer, the bank customer would just have to it's as if they invested in an insolvent business at that point. That's
Yeah.
essentially what would
Mhm.
happen.
Either they'd lose their deposit,
Mhm.
which would cause a run on every other bank instantly,
Yeah.
or there would be another massive taxpayer bailout,
Uh-huh.
which is, oh, wait, who are taxpayers? Oh, yeah, bank depositors are taxpayers. So you're losing money either way is the idea there. So I don't have a lot of faith in my bank being
Mhm.
a safe place to park money. And I'm happy to say that you
Mhm.
and I are working with our clients to give them alternatives. What would we do instead, Sarry? Tell me what's the alternative?
Well, yeah, definitely. Because as we started recording, we talked about the differences between like specifically life insurance companies and how they handle their money versus banks. So, like, in my opinion, I think, and part of the bank on yourself concept is that life insurance companies are the safest place on earth to store your cash in because it's actual real cash that's there and that's properly managed and that's regulated I think every quarter. It's regulated by every state that an insurance company operates in. So I prefer to park money there. So yeah, I see that happening. I just think that what would happen in the case of like if everyone puts their money into cash value whole life insurance, how do we still use it like for paying our electric bill or our water bill? That's kind of
Mm-hmm.
where I'm confused at. Maybe you can help me
Yeah.
bring some clarity there. Like, how do we use it on a daily functional basis?
Yeah, you're right. You don't get a debit card associated with your life insurance policy or
Yeah.
anything. So,
Yeah.
and there's nowhere to get like a life insurance ATM machine that I'm aware of.
Yeah. Yeah.
So, my best answer to this great question, it's a thoughtful question, is we've gone through banking crises before,
Mhm.
even before FDIC and life insurance companies were able to make it. Think of it this way: as long as there is exactly one bank in the entire world, doesn't even have to be the United States. As
Yeah.
long as there's a bank open in the world with
Yeah.
a ability to get, checks written, you can have the insurance company direct your loan
Mhm.
request to the Switzerland bank that's still open, and you can operate your life as normal.
Mhm.
When everyone else is without money. And oh, by the way, it's like the one-eyed man becomes king in the world of the blind. When you're the one with a big pile of money in your wheelbarrow and everybody else is seeing their deposits going to zero,
Mhm.
what do you think is going to be happening to real estate
Yeah.
or stocks or any other asset, raw land, whatever you're into? And now you've got the giant pile of money because you were able to access your contractual guaranteed
Yeah.
cash value. What could you possibly do with all that money whenever the world is on fire and no one else has access to their cash?
Yeah, yeah, you'd be able to buy it at a fraction of the cost, and I think that's happened already in some places in the world, like in Lebanon.
Mm,
Cash essentially is the government is holding up cash, so people now are
mm,
using assets and they're using other things to get by, just to buy groceries, just to get through. So yeah, it's going to drive the price of assets down because there's no cash in the economy to buy
mm.
those things. So yeah, it's gonna and then in the case of the investor who has access to guaranteed growing cash, it gives that person the upper hand because when they go borrow from the insurance company is not going to give you a loan based off the asset you're buying. They're going to give you a loan based off of the insurance policy as an asset.
Tell me more about that and why that's so important.
Yeah, yeah. So like for example, in 2008, one of the biggest problems was if you had great credit, you had great income still, and then you wanted to buy a property, or you had a property, for example, and then you had it paid up and you wanted a loan against it. They're gonna look at your credit, they're gonna look at your income, but they're also gonna look at the value, the market value of your property. And the market values of properties in 2008 they were impacted dramatically, like probably like by like 50 or 60%. So if you had a house that was 300,000, the bank will say, if the bank was willing to give you a loan, they would say, well, we'll give you a loan up to like 150,000. So like 80% to LTV. And then let's just say you needed 300,000 in that case, that's gonna really hurt you to take like half that money as a loan or even to sell that. But if you had that money in a whole life policy and then you wanted to buy a home, for example, the insurance company is not going to look at the property. They're going to look at the insurance policy itself. Okay, you have 300,000. We'll give you 90% of that 300,000 as a loan, regardless of you whatever you use the money for.
Mm, that's awesome, man. Yeah, I'm just working with someone who she has 8, 9 properties right now, and she's wanting to purchase another one. She's selling one in her portfolio, and she wants to buy another one. And no banker, with interest rates rising,
Yep.
it gets tough to become really loose with lending. So very few bankers are really excited to give out loans at low interest rates. Well, life insurance policy loans are way below. I saw a 12% HELOC the other day.
Yeah.
12% HELOC. And of course, bank credit cards are at 24% on the average, last I checked. But life insurance policy loans, if you take a loan from a policy and you repay that loan over a reasonable period of time,
Yeah.
pick a length of time, let's say 8 years, it's going to be under 3% APR, annual percentage rate, according to where things are at right now with the insurance company policy loans. Why are they allowed to do that? Why are they able to do that? Because they know you're good for it. They know you're going to pay that back, because even if you don't pay it back during your lifetime, gets deducted from the death benefit when you pass away.
Yeah, exactly. And we were talking about this before we were recording. It's not like when you go take out, for example, from one of the insurance companies, Lafayette Insurance Company, you go to take out a loan from them. It's not like they have to leverage another commercial bank for that. They're taking money out of their literal accounts, their funds, and then loaning that out to you. So that means that it's not like we looked at some of the projections. If you get I think a policy in November of this year, interest rates are 5% still. So that means that regardless of what happens with the prime rate between May of this year and November of this year, it's still 5%. And then the reason why is because they're not leveraging that money from other commercial banks. Whereas you can never go to your mortgage lender right now and say, hey, in November, let's lock in the rate from now. I think you can lock it in, I think like 30 days before or something like that, a very short window. But no lender's going to say, I'll lock it in from now, because what if interest rates go up, like dramatically go up, then the bank is going to lose money on that loan. But insurance companies don't have those same restrictions or those same problems.
That's right. You're locked in. Your rate is locked in for a whole year. That's a great deal when it comes to like just having some certainty. And for a lot of families and businesses, certainty is a rare commodity these days.
Yeah.
You mentioned 5%, and I don't want to dither with too much here because I know our time is getting short, but you're right. 5% is a great deal right now, even for a mortgage right now. But it's a 5%. I'm sure you know this and you tell your clients this, but I'll just let your audience know. It's a 5% simple interest rate. So what's the difference between 5% compound and 5% simple, and why does that matter?
Yeah, it's a lower cost of capital. So like when you, for example, your credit card balance will roll over month after month. It'll carry the previous balance and then roll it forward. So it ends up costing you a lot more money in interest. Whereas with life insurance loans, you take out a loan, for example, 5%, they would take that amount, let's just say $1,000 in total interest that they calculated, then they would divide that by 365 days, which comes out to like $1 a day in a loan, that increases your balance. So in general, it's a much cheaper form of using capital when you have simple interest.
And just to put some numbers on that, if it took you about 8 years to pay off a loan with 5% simple interest, that works out to, like I said, about 3% annual percentage rate, which is even better than 5%. That's better. Heck, that's better than any other loan I can find out there on the market right now, which is why a lot of people are using their policies, Sarry, to pay down or pay off their HELOC, their home equity line of credit, or even to pay off their house mortgage. I'm even seeing people make the decision to borrow from their policy and wipe out their higher interest mortgage. We just had a couple. They used a policy loan. They had bought their house the normal way with a mortgage at it was a pretty high mortgage, historically speaking, and 6% something. And they said, all right, we're going to pay on this mortgage for a year or two, but we're going to just cram money into our policy such that in just a year or two, we'll be able to pay off the mortgage with our policy and bring their interest rate down. And talk about a relief, because now their repayments on their policy loan are optional to them. They can lower it down if they need to, raise it back up if they need to. They have a much better interest rate over time, and they're in control.
Yeah, I think, like when we put it this way, I think everyone should be using this in some sort of way. Like it's the same thing as, instead of just paying off your loan directly faster to the lender, the principal interest faster to them, you have it go through a policy first, and then you leverage your policy, and then you use that money to pay down the loan faster because you want to save it, I guess, first before you just give it to the lender directly. Because if you want that money back, now you have to refinance or you have to go through the whole banking process again. But if you have to go
Hmm.
through your policy first and then you borrow against that, then you can, in the future, you can come back and say, well, I've built up this much in my whole life policy. Now I'm gonna just borrow against it. Yeah, Mark, I know we're running short on time. Thank you so much for joining us today. I really appreciate you being on the show again, and for your input.
Yeah, no problem. Let's do this again as
Yeah,
much as you want, man. Thanks a lot for having me on.
thank you. To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.